Hello everyone. Now we are going to start the concepts of CFA level 3, and the book which we are going to cover up first of all is your asset allocation. Asset allocation. Now what is asset? Asset means what? Your bonds, equities, it can be your commodities, it can be your precious metals like gold and silver, private equities and hedge funds like this. Okay, so if you have 100 rupees in your pocket, then how you are going to put that money into multiple asset, or you can say how you are going to allocate your 100 rupees into multiple assets. This is what we are going to study in this particular core area. Okay, now this comprises of 5 readings. Now the first topic is about capital market expectation. Capital market expectation. Now this topic is divided into two parts. First one is your framework and macro consideration. Framework and macro consideration. Second one is your forecasting asset class returns. Forecasting asset class returns. Clear? Then another topic which we have to do is overview of asset allocation. Overview of asset allocation. Overview of asset allocation. Then we have fourth topic is principles of asset allocation. Principles of asset allocations. And the last one is asset allocation with real world constraints. Asset allocations with real world constraints. So now I have given you an overview like what we are going to study in the whole topic of asset allocation. There are 5 readings. Now this reading is actually divided into 2 parts. Okay, and this is your third, fourth and fifth, and all are interlinked with the asset allocation. First, discussing about the capital markets. Clear? Second, discussing about how you are going to allocate the assets. What are the principles in the next topic, and what are the difficulties we face in real life. Clear? So this is how 5 topics are going to be covered up in your topic asset allocation. Now we are starting with the first topic, capital market expectation, and inside that my focus will be on framework and macro consideration. Means I am talking about the whole economy at macro level rather than focusing on individual asset or individual topic. Clear? So now give the heading framework and macro consideration. Framework and macro consideration. Now inside this we are going to study 4 different modules. Write down the first one is formulating capital market expectations. Formulating capital market expectation. Next one we have is the trend rate of growth. The trend rate of growth. Then we have is the business cycle. The business cycle. And the last one is monetary and fiscal policy. Monetary and fiscal policies. Clear? These are the four modules which we are going to study in the framework and macro consideration. Now, let us begin with our first part, your first LOS, that is discuss the role of a framework for capital market expectation. Write down the word capital market expectation in the portfolio management process. In the portfolio management process. See, ultimately what's my goal is that with the help of the assets, I have to build my portfolio. Clear? Now, in that portfolio, what role does this capital market expectation actually plays? Clear? That what we are going to study in this LOS. So, first of all, we'll see what is this capital market expectation, why they actually matters. Clear? Then exactly how we build them in a very disciplined way so that we can make our portfolio decision to be very smart enough. Okay, that we can bring better returns with the lowest possible risk. Clear? So think of this capital market expectation is just like you're forecasting the weather for the purpose of money. Clear? So when you I'll give you one example. When I plan some outdoor events, okay, what I'll do, I'll look for the weather forecast and I'll decide that whether I need to carry an umbrella or set up a tent. Clear? Because I have my outdoor event, so definitely I'll do it before that, because if I know that tomorrow it might rain and if I am not having that protection with me, then there is a difficulty to me. Clear? Similarly, investors will also make a plan in sense means how much to invest in stocks. Like I'll say asset allocation means how much to invest in stocks, bonds, real estates. Clear? On what basis they will decide. See, there are three options to an investor. Suppose we have stocks, we have bonds, and we have real estate, and I have 100 rupees. Now you'll ask me, sir, where I'll put my money. I'll say that I'll invest in bonds, because right now I fear that the prices of stocks and the real estate can go down because of the recession, so bonds can protect me. Clear? So what I'm aiming for, I'm asking the future return and risk. So I will choose a portfolio in which I can get better returns with lowest risk. Clear? So I will allocate my money in such a way that I can increase my return and reduce my risk. Clear? Now, if the forecast is clear and well made, you will definitely take a better decision. Otherwise, it will become a wrong decision and hence your portfolio will suffer. Clear? Now, the first question which comes to our mind, that is, sir, what are capital market expectation? Sir, what are capital market expectation? Now, when I'm saying capital market expectation, so over here, when I'm using the word expectation, so this expectation is about the risk and the return. The risk and the return for group of investments, for group of investments. Now, when I'm saying group of investment means asset class. Okay, where you are including your stocks, your bonds, as well as your real estates. Clear? Now, these expectations are for long term. Okay, as well as for short term. Clear? Means if you are going to put your money in this asset class, clear? Now this asset class, actually you have invested via portfolio, clear? Now if you'll invest in this portfolio, say for 3 months, what you will make, and for 30 years, what you will make, both short term as well as long term, clear? So what is capital market expectation? Sir, I am actually analyzing, forecasting the risk and return for the asset class for short term as well as long term. So now the question comes, why they matter in portfolio management? Why they matter in portfolio management? Definitely. So then why I am doing this? So there are three reasons. If I'm talking about why, then I have three reasons. Starting with the first one, asset allocation will drive the result. Write down, asset allocation will drive result for us. Clear? Second, consistency and coherence. Consistency and coherence. And the last one is decision making. Decision making. Clear? Now, the first point which I want to discuss over here is your asset allocation will drive the result. Now, try to understand. If I am creating two portfolios, okay, portfolio A and portfolio B, clear? I have equity, I have bonds, and I have gold, clear? Suppose over here my ratio is 80%, 10%, and 10%, clear? Say over here 40%, 40%, and 20%, clear? Suppose equity gave the return of say 4% because of the poor market, and bonds are still giving you the good return of say 8%, and gold have actually given you some excellent amount of return, say 25%. Now tell me which portfolio actually gave you the best returns. So over here, let us start one by one. 0.8 multiplied with 4%, that is 3.2, this 0.8 and 2.5. So what is the total? 3.2 plus 0.8 plus 2.5, 6.5%. The return of the portfolio A is 6.5 versus, now let us compare over here. 4 multiply with 0.4, 1.6, then 8 multiply with 0.4, 3.2, and over here it is going to be 5. Clear? So it is going to be 9.8%. Now what's the reason that my portfolio B actually gave me the higher return? The logic behind this is my asset allocation. Clear? Over here you can see that my investment in the gold is higher, and the gold return is also higher, and hence my portfolio return increased. Clear? So the point is that if you are selecting the right capital market expectation, then it will actually help the investors to choose the right mix, and that will deliver you the higher possible return. So it's totally expected. I'm not saying it's for 100% sure, but there is higher probability if it is your expectations are correct and you're working exactly what you have planned, then you will deliver the better results. Clear? Coming to the next one, that is your consistency and coherence. Clear? Means your expectations, okay, what you have forecasted, they should make some logical sense around all asset class. Clear? As well as over time. Means it's not like that you have calculated for the year 1. Now that should also match for year 2, year 3, year 4. Clear? Across all assets as well as over time. Like I'll tell you, suppose I'll say that, suppose I have predicted that the stocks will give me the return of 12% with low risk. Clear? Bonds, I have predicted that it will give me the return of 8% but with high risk. And cash, I will generate the return of 6% with zero risk. Suppose I've invested in the some treasury bonds. Okay, they are equivalent to cash only. Now, can you see that this is inconsistent? Why? Because stocks are normally riskier than bonds. So this point is not matching because bonds should be less risky as compared to the stocks. Clear? So if your forecast say otherwise, then your model or assumptions are likely to be wrong. Clear? So what I have to do, I have to make it coherent, means consistent. So for 12%, I must say that my risk is 15%. For bonds to generate the return of 8%, my risk is say 9%. Clear? And the cash, there is a possibility that even the sovereign bond sometimes fails. Clear? So risk is a 1%. Clear? So now this picture actually makes sense. Higher the risk, higher the expected returns. Clear? And coming to the last one, better decision making. And the point is that over here I should reduce my emotion. Clear? So when you are structured and your processes are completely data based, clear, to set your expectations, then your decisions become rational rather than emotional. So over here what I want to say that, sir, I want to be rational. My decision should be data driven, should be structured rather than emotional. Clear? So I'm not reacting to every market headlines. What I am doing, I'm guided by the research. See, we all know that during COVID-19 crisis, stock market crashed by 30-40%. Okay, many investors panicked and they sold everything. But the one, those who are disciplined investors, okay, who had the capital market expectation based on the long term fundamentals, like in the long run our equity are going to be very good. So instead of selling, they could have stayed invested or even bought more during that COVID time. They would have not only recovered, but they would have made huge amount of returns for their investors. Are you clear? Now, when I'm saying the word consistency, consistency should come from both sides. Means when you are saying this thing, okay, sorry, this one, it should be consistent from both angles. One is from your different asset class at the same time and across different time period as well. So we have two terms for that. Number one is your cross sectional consistency. Cross sectional consistency. Then we have intertemporal consistency. Now this cross sectional consistency, write down, across different asset class at the same time. Across different asset class at the same time. Underline different. Clear? And for this intertemporal consistency, write down across different time periods. Underline different time periods. Clear? So when I'm saying cross sectional consistency across different assets, means when you make forecast for multiple asset class, for equities, for bonds, for golds. Clear? Now what you are actually doing, you are actually forecasting, clear, putting out their numbers, their risk and return, and now you are trying to compare so that they can make sense when they are relative to each other. Because if you have four different asset class, you have your risk and you have your return. Based on these information, you will take the decision where to invest and where not to invest. Clear? Now if they are not consistent, then how you will take the decision? Clear? Suppose I'll give you one example. yeah, this example is enough. Like if I'm saying that my equity return is 12, bond 8, cash 6, clear, and I'm saying that risk is low for the stocks but high for the bonds. So what I say, they are not consistent. Clear? Why? Because bonds are actually less risky than equity, but they have higher expected return. Clear? So you can see that factually they are not supporting the general norms. Clear? So when I'm saying this with a low return on equity and high risk in the bonds, I'm saying like that I will get higher marks in the subject even if I don't study for it. So do you think it really fits for it? It won't. Clear? So what you need to do is you need to make sense. Higher the risk, higher the expected return. Clear? Now, coming towards the time, okay, that means your intertemporal consistency where I am saying it across time. Clear? Suppose I am saying that 1 year expected return of the equity is 12%. 1 year expected return of the equity is 12%. Clear? And 5 year expected return total, I am saying total, is only 20%. Now this is inconsistent because for 1 year if you are saying it 12%, then for 5 years it should be more than 60% annually compounded. Clear? It should be much higher than 60%. So what is happening over here? Your short term and long term expectation will not match. I call this as intertemporal inconsistency. Then sir, what is consistent? If I'm saying 10% is your 1 year return and over the 5 years my return is 61% total. So now this is consistent with my 1 year view. Clear? I call this as intertemporal consistency. Now there is one more point. The point is rebalancing the portfolio, because there are many investors, they keep on rebalancing. Means this year you have a ratio of say 60 30 10 equity, bonds and say gold. Clear? Next year they found out that equity won't perform well, so they will invest more in the gold because they have higher expectation with respect to the gold. So what they will do, they will do the rebalancing. They will do the rebalancing, and this is your next year asset allocation. Say after 3 years again they rebalance it. Clear? So if you will not consider this in your rebalancing portfolio, then your forecast is actually inconsistent over time. I call this as again intertemporal inconsistency. Clear? Because over time you have not assumed the rebalancing while calculating the return and the risk of your portfolio. Clear? Because there are many investors who are going to rebalance, because every year you cannot keep 60% in your equity, because no one can assume that for the next 10 years there will be a boom in the equity. So what you will do, you will rebalance, because now you know that market is going to crash. You will take your money out and put it into the bonds. Clear? Now you know that market is going to boom. You will take your money out from the bonds, you will put it into the equity. Clear? So your long-term return must reflect your early rebalancing. If it will not, it will become again an example of intertemporal inconsistency. Clear? Now moving ahead with a 7-step process that how to formulate the capital market expectations. Okay, so we have 7 steps. Number 1, decide what expectations you need. Decide what expectations you need. See, basically there is one term, that is IPS, investment policy statement. Clear? So suppose I am an investor. Clear? And you are an organization who is taking the money from me and now you are investing. Clear? So I'll tell you that don't invest my money into the gold. The only investment you are allowed to do is say bonds and equity. So now you will do your capital market expectation as per my requirement, as per my investment policy statement. Clear? Also I'll tell you that I want a long term investment, so accordingly you will plan my capital market expectation. Like I'll give you one more example, a pension fund. Okay, they allow only the large cap equity, emerging market equities, government bonds, corporate bonds, and real estate. Clear, and they are meant for long term because this pension fund is to be utilized when during the retirement. Clear. So this is not good for the active traders who will do buy selling. No, they will invest today with the view that they have to take the money out after say 10 years, 15 years, or 20 years down the line. So they will plan that what will be my return and risk over the period of 20 years. So this IPS, investment policy statement, will define what is the goal of the investors, what are the constraints, what are the allowable assets. Clear, how much risk I can tolerate. Clear. Coming to the second step, that is your study historical performance and drivers. Study historical performance and drivers. See what you will do. Historical performance, you will go to the past, you will take all the data and you will identify that from where you are getting the return. So for that, what information you need? I need the GDP growth, I need the inflation, market drivers like valuations, policy drivers like interest rate. Clear. I will pick up all these information and then I'll decide that what are actually the drivers which actually help me to identify that, say, okay, GDP is increasing and hence the return of my portfolio is also increasing. So there is a correlation between them. Like I'll give you one example from 2000 to 2020, US large cap, they have given the return of say 15 to 16% approximately. Clear, because of the strong earning growth, multiple expansion. Clear. But for the bonds, returns are heavily dependent upon the interest rate movement. Clear. And interest rates were very highly fluctuating, sometimes way too high and like COVID crisis, and sometimes it's way too low, means even there are time there investors don't want to invest in the bonds because they are getting say 1% or 1.5%. Clear. So it's very fluctuating. Accordingly, you need to decide that where I am going to put my money, into the equity or into the bonds. If I'll see that equity markets are riskier, I'll put my money into the bonds. And if I'll see that I'm not getting good return in the bonds, I'll take that money out and put that into the gold. Like this, I'll keep on shifting from one asset to another. I am going to rebalance. Now, I'll also check for the economic drivers too. Next step is to pick my valuation model. That which model I am going to use to actually identify that what is my risk and return. So there are multiple methods. Like I can do the comparison, or I can say the word relative value like P ratio. Clear. So I can compare it with the peers and I'll also compare it with the historical data of the same company. Clear. Like suppose I want to invest in India. So what I'll do, I'll calculate the price earning ratio of India. So what I'll see that historically it was 12. Right now it is trading at 8. So means what? It is undervalued. So I should invest in India. Clear? Or another way, DCF calculation, discounted cash flow models. So what I'll do, I'll forecast the cash flow and discount them to the present. And this is often used for the individual stocks. You cannot use it for the whole portfolio. Individual stocks, DCF. And then based on that, I'll see which one is overvalued, which one is undervalued, and accordingly, I'm going to invest. Clear? Next we have is yield and term structure model. Over here, I am going to forecast the interest rate for the bonds. That what will be the forecasted interest rate in the next 2 years or 3 years or 10 years or 30 years down the line. Clear? And the last one is macro, where I'll forecast the GDP, I'll forecast the inflation, I'll forecast the employment factors. All these things needs to be calculated. Based on that, I'm going to decide where to invest, how much to invest. Clear? Now, if you are going to use a model, you have to get the data. because without data, what you will do with the model? So fourth point is collect the data, because once you have decided the model, now you know that what data you need. Suppose you need the data of GDP, you need the data of interest rate, you need the data of inflation, okay, you need the data of companies. Clear? You have collected all the data, now you are going to use that. Clear? Well, get the data from the financial database, central bank data, IMF, World Bank for the macros. Clear? And there are some vendors, they are going to provide the data for the market prices. So don't use the garbage, because there are huge amount of data which is useless, unreliable. No, don't use that. Get the data from the reliable sources only. Clear? Like for the inflation, you can take the data from the central bank. Clear? They have the short term as well as long term target. Clear? Now once you have the data, next step is use judgment and experience so that you can set the inputs like risk premium, expected earning growths, long run interest rate. Clear? Accordingly you can decide that, because sometimes what happens now, there is a conflict between the data and the reality. Okay, so you need to over here use your own judgment that yes, whether this data is justified or not. Clear? Whether this data is consistent across the asset class or not. Clear? Because you want your returns, your calculation to be realistic. Clear? So now you have the data, you have the model, you will enter the data into the model, then model will give you the outcome. Clear? So write down those expected risk and return for each asset class, the model which you have used, the assumption which you have used. Clear? And at every step start recording it. So now what you will have, you will build a strong database. Clear? And then the last point is monitor and refine it. So always track how your forecast performs. Clear? Update the process. If actual returns differ significantly from your expected return, then try to investigate and adjust your models accordingly. Clear? Now, when I'm calculating all these expectations, so one thing is clear that I need this information from the geographic perspective as well, means country level. Okay, like India, US, China, Japan, because when I am an investor and I am a very big investor. Clear? So what I'm doing, I'm investing my money into multiple countries, so I need the data from all countries perspective. Clear? I need to consider all the major asset class, equities, fixed income like bond, your real estates, your commodities, and sub asset class too, like inside equity I need to focus on large cap versus the small cap. I need to focus is on the value growth, value versus growth. When it comes to the bonds, I need to focus on both nominal as well as treasury inflation linked. Clear? Then I need to focus on floating versus the fixed rate, credit qualities, maturity. Sometimes I want to invest in say 6 month bonds, sometimes I want to invest in the 30-year bonds. Clear? Real estate, commodities, timberland. So when I will diversify my assets, diversify my geographic, then this calculation will also needs to be expanded for every asset class, every country, and for every term, short term or long term. Clear? Now I have just introduced you in this lecture capital market expectation and its steps. Clear? In the next lecture, my focus will be on what are the problems we are going to face during the forecasting. Clear? So with this, I'm ending this lecture here. Thank you.